Today is Wednesday, 4th of June 2025, 6 a.m. Eastern Time. This news is brought to you by Preeti Capital, your trusted source for financial insights. In the latest trading session, the financial markets displayed a mixed yet noteworthy momentum, characterized by a significant rally in technology stocks, which played a pivotal role in driving gains across major indices. This upward trend in the tech sector was mainly attributed to robust earnings reports and positive forecasts from key industry players, reinforcing investor confidence in the sector's growth potential. Concurrently, global uncertainties continue to loom large, injecting a degree of caution among market participants. Investors are keeping a close eye on geopolitical developments, including ongoing trade discussions and regional conflicts that could potentially disrupt global supply chains and economic stability. These uncertainties have led to a more cautious approach in sectors directly impacted by international trade and geopolitical tensions. In this environment, major indices reflected a blend of optimism and caution. The tech-heavy indices outperformed, buoyed by the strong performance of leading technology firms, while other sectors displayed a more muted response due to the prevailing uncertainties. This divergence highlights the current market sentiment, where confidence in technological innovation is counterbalanced by broader geopolitical apprehensions. Meanwhile, the commodities and currency markets reacted sensitively to these global cues. Commodity prices showed varied movements, with some experiencing volatility as traders assessed the impact of geopolitical events on future supply and demand dynamics. Similarly, currency markets witnessed fluctuations, driven by investor sentiment shifts and economic data releases that provided insights into the potential trajectory of monetary policies across different regions. Overall, today's market activity underscores the complex interplay between sector-specific strength, particularly in technology, and the overarching influence of global geopolitical factors. Investors are navigating these dynamics with a blend of optimism and caution, reflecting the nuanced landscape of the current financial environment. The global financial markets exhibited a generally positive trend as major indices closed in the green. The S&P 500 advanced moderately, reflecting a broad-based gain across various sectors. This movement suggests a continued investor confidence in the economic recovery and corporate earnings. The technology-heavy index showed a robust performance, indicating strong investor interest in tech stocks, which have been pivotal during the recent economic upturn. The Dow Jones Industrial Average posted a modest gain, highlighting a balanced performance among its constituent blue-chip stocks. This index's rise underscores the stability investors are finding in established companies during periods of market uncertainty. Meanwhile, the Russell 2000, which gauges the performance of smaller companies, surged significantly. This jump could be interpreted as a renewed investor appetite for riskier, yet potentially rewarding, small-cap stocks. In volatility measures, the VIX, often referred to as the Fear Index, demonstrated a notable decline. This decrease suggests that market participants are experiencing less anxiety about near-term volatility, perhaps due to positive economic data or reassuring central bank policies. European markets followed suit, with the FTSE 100 and the DAX both registering gains. These indices' performances highlight a positive sentiment across Europe, possibly driven by steady economic indicators and corporate earnings. Over in Asia, Japan's Nikkei 225 and Hong Kong's Hang Seng Index both saw appreciable increases, reflecting optimism in the region's economic prospects. The Shanghai Composite also ended higher, albeit modestly, indicating a cautiously optimistic outlook among Chinese investors. Overall, the upward movement across these indices points to a market environment that is currently buoyed by economic resilience and positive investor sentiment. However, the underlying global economic conditions and geopolitical factors remain critical in shaping the future trajectory of these indices. In the current landscape of bond yields, we observe a mixed performance across different maturities. The yield on the 10-year Treasury note stands at 4.46%, showing a slight decrease of approximately 0.448%. This movement suggests a marginal increase in demand for the 10-year bonds, perhaps indicating investor sentiment leaning towards safety amid uncertain market conditions. The modest drop in yield might reflect cautious optimism about future economic stability or an anticipation of potential policy shifts by the Federal Reserve. Conversely, the 13-week Treasury bill yield has risen to 4.235%, marking an increase of about 0.0709%. This upward movement may suggest heightened expectations for short-term interest rates or increased issuance pressures. It could also imply that investors are seeking liquidity and flexibility, opting for shorter-term securities in anticipation of future economic adjustments or shifts in monetary policy. Meanwhile, the 30-year Treasury bond yield has decreased to 4.983%, a notable decline of approximately 0.2402%. This significant drop might indicate strong demand for long-duration assets, possibly driven by expectations of lower long-term interest rates or a flight to quality as investors seek to lock in yields before potential rate cuts. The decrease in the long bond yield could also be reflective of concerns about economic growth prospects, prompting investors to secure long-term returns amidst potential macroeconomic headwinds. These movements across various maturities paint a complex picture of investor sentiment and market dynamics. While short-term yields reflect expectations of higher rates, the drop in long-term yields suggests a more cautious outlook on economic growth and inflation. This bifurcation in yield movements highlights the ongoing balancing act faced by investors navigating a landscape influenced by both domestic and global economic factors. As market participants continue to assess these dynamics, bond yields will remain a critical barometer of financial market expectations and economic health.